The American financial system is built on a bedrock of trust. This trust is the invisible thread that weaves through every transaction, every loan, and every investment, holding the entire system together. When that trust cracks, even slightly, the tremors can be felt far and wide, rippling through the economy like aftershocks from an earthquake. Today, those tremors are emanating from an unexpected source: small and regional banks. These community pillars, often seen as the backbone of local economies, are now at the epicenter of financial instability. These institutions, often overlooked amidst the titans of Wall Street, are facing a confluence of challenges that threaten their stability and, by extension, the health of the broader economy. The struggles of these smaller banks are a stark reminder that financial crises can originate from the most unassuming places. The numbers paint a stark picture. Financial reports reveal a troubling trend of declining asset values and increasing liabilities. Over 280 banks across the United States are currently grappling with a dangerous cocktail of commercial real estate loans gone sour and the relentless upward march of interest rates. These factors are creating a precarious situation that could have far-reaching consequences. This perfect storm has pushed these institutions to the brink, raising the specter of bank failures and a crisis of confidence not seen since the dark days of 2008. The potential fallout from this situation could be devastating, affecting not just the financial sector but the everyday lives of millions of Americans. At the heart of this brewing crisis lies commercial real estate, or CRE. Unlike residential mortgages, which are backed by the homes of individual borrowers, CRE loans are secured by office buildings, shopping malls, and other commercial properties. These loans, once considered relatively safe bets, have become a ticking time bomb in the portfolios of many small banks. The COVID-19 pandemic accelerated a trend that was already underway: the decline of traditional office spaces. With remote work becoming the norm for millions of Americans, demand for office space has plummeted, leaving landlords struggling to make their loan payments. This, in turn, has left banks holding billions of dollars in potentially toxic assets. Adding fuel to the fire is the Federal Reserve's aggressive campaign to tame inflation. The Fed's decision to raise interest rates at a historic pace has had the desired effect of cooling down the economy, but it has also made borrowing significantly more expensive for businesses and consumers alike. For small banks, the impact has been particularly acute. Many of these institutions rely heavily on short-term borrowing to fund their operations. As interest rates have risen, so too have their borrowing costs, squeezing their profit margins and leaving them with less capital to absorb potential losses. The failure of even a single bank can have ripple effects throughout the financial system, affecting not just the bank's customers but the entire economy. When a bank fails, depositors lose access to their funds, often causing panic and uncertainty among the public. Businesses lose lines of credit, which can be devastating for small businesses that rely on these funds to operate and grow. The broader economy can grind to a halt, leading to reduced consumer spending, lower production, and increased unemployment. While the Federal Deposit Insurance Corporation, or FDIC, insures deposits up to $250,000 per depositor, per insured bank, this safety net has its limits. Many businesses and individuals hold accounts with balances exceeding this limit, leaving them vulnerable in the event of a bank failure. To prevent a domino effect, regulators often step in to orchestrate mergers or provide emergency funding to struggling institutions aiming to stabilize the financial system. However, these interventions come at a cost, both financially and socially. Mergers can lead to job losses and reduced competition in the banking sector, which can hurt consumers in the long run. Government bailouts can erode public trust and create moral hazard, where banks may take on excessive risks, knowing they will be rescued if things go wrong. This cycle can perpetuate instability in the financial system. Community pillars, systemic risks. Small and regional banks play a vital role in the U.S. economy. They are often the primary lenders to small businesses, providing the capital they need to start, grow, and create jobs. They also serve as important pillars of their local communities, providing personalized service and supporting local initiatives. The challenges facing these institutions pose a systemic risk to the financial system. If a significant number of small banks were to fail, it could trigger a credit crunch, making it difficult for businesses to obtain the financing they need to operate. This, in turn, could lead to job losses, business closures, and a broader economic downturn. The Fed's Balancing Act. The Federal Reserve faces a delicate balancing act. On the one hand, it must continue to combat inflation, which remains stubbornly high. On the other hand, it must do so in a way that does not inadvertently trigger a wave of bank failures. The Fed has taken some steps to address the stress in the banking system, such as providing emergency lending facilities to banks that are struggling to meet their liquidity needs. However, these measures may not be enough to avert a crisis. Mergers, acquisitions, and regulatory scrutiny. In times of financial stress, mergers and acquisitions, or M&A, often accelerate in the banking sector. This is because financial instability can create opportunities for stronger banks to acquire weaker ones. Larger, well-capitalized banks may see an opportunity to acquire struggling institutions at a discount, expanding their market share and potentially benefiting from economies of scale. These acquisitions can help banks grow rapidly and increase their influence in the market. However, these M&A deals are not without their drawbacks. The process can be complex and fraught with challenges. They can lead to job losses as the acquiring bank streamlines operations, often resulting in redundancies and layoffs. This can have a significant impact on the local economy and the lives of the employees affected. Additionally, they can reduce competition in the banking sector. Fewer banks mean less choice for consumers, which can lead to higher fees and less favorable terms for banking services. Regulators are acutely aware of these potential downsides and are likely to scrutinize any proposed M&A activity in the banking sector very closely. They aim to ensure that the benefits of such deals outweigh the drawbacks. They will be looking to ensure that any deals are in the best interests of consumers, do not pose a risk to financial stability, and do not stifle competition. This regulatory scrutiny is essential to maintaining a healthy and competitive banking environment. The importance of small banks. Small and regional banks are the lifeblood of many communities across the United States. They provide essential financial services to individuals and businesses that may not have access to larger institutions. They understand the unique needs of their communities and are often more willing to take on risk to support local businesses and initiatives. Their importance extends far beyond their immediate communities. They play a critical role in fostering economic growth, creating jobs, and supporting entrepreneurship. The loss of these institutions would be deeply felt across the country. The search for solutions. Addressing the challenges facing small and regional banks will require a multifaceted approach. Policymakers, regulators, and industry leaders must work together to find solutions that ensure the stability of the financial system while preserving the vital role these institutions play in the economy. One potential solution is to provide targeted regulatory relief to small banks. This could include easing capital requirements, streamlining regulations, and providing incentives for banks to lend to small businesses. Another solution is to encourage private capital to flow into the banking sector. This could involve creating tax incentives for investors who are willing to provide capital to struggling banks or establishing a fund to support community banks. Restoring confidence. Ultimately, the key to addressing the challenges facing small and regional banks is to restore confidence in the financial system. This will require transparency from regulators, prudent risk management by banks, and a commitment from policymakers to address the underlying economic challenges that are contributing to the stress in the banking sector. Restoring confidence will not be easy, but it is essential. A healthy and vibrant banking system is critical to the long-term health of the United States economy. A call to action. The challenges facing small and regional banks are real and they are serious, but they are not insurmountable. By working together, we can find solutions that protect our financial system, preserve the vital role these institutions play in our communities, and ensure that all Americans have access to the financial services they need to thrive. This is not just a matter of economics, it is a matter of fairness, opportunity, and the promise of the American dream. Let us rise to the challenge and ensure that our financial system works for everyone.